Auditing is a distinct subject, often studied at the graduation level, for example in BCom programs. While many are familiar with accounting, those from non-commerce backgrounds might not be as acquainted with auditing. Essentially, auditing begins after accounts have been prepared and financial statements have been made. An auditor, who is separate from the accountant who prepares the accounts, then verifies these financial statements. The primary purpose of this verification is to identify if any errors or mistakes have occurred in the accounts. This subject is particularly relevant for individuals preparing for the APFC, EPFO, APFC examination, though it is not typically part of the syllabus for other exams. The focus for such exams is on the basic aspects of auditing rather than in-depth study. Key topics include the introduction to auditing, its meaning, the meaning of the word audit, the difference between accountancy, accounting, and auditing, objectives of auditing, and types of audit. Among these, types of audit are considered very important, with many questions arising from this area, along with the origin of the audit word and the distinction between auditing and accounting. Meaning of audit and auditing. The term audit originates from the Latin word audio, which means to hear. This is an important detail for examination purposes, as questions might inquire about its Greek or Latin origin. Historically, the scope of auditing was not as significant, with organizations primarily focusing on preparing financial statements without necessarily verifying them. However, with the increasing complexity of business, the scope of auditing has greatly expanded. Currently, for certain companies, particularly public companies, auditing has become compulsory according to the Companies Act 2013. The main object of modern auditing is to verify the financial position of a business as disclosed by the balance sheet and profit and loss account. These two statements are considered crucial because the profit and loss account reveals the net profit or net loss, and the balance sheet reflects the financial position. While auditing also includes the examination of cash transactions, cash books, and trial balances, the emphasis in modern auditing is predominantly on financial statements. Auditing itself is defined as a process, similar to how accounting is a process from ledger to trial balance and then to balance sheets and P&L accounts. Auditing is the process of verifying financial statements. The formal definition states, auditing is a systematic and independent examination of data, statements, records, operations, and performance of an enterprise to ensure the compliance with certain standards. This process involves examining all information and financial statements provided by the accountant. The auditor's role is critical because an accountant, despite preparing accounts, might lack sufficient knowledge or commit errors, such as errors of principle or errors of omission. The auditor is responsible for finding out these errors. Additionally, auditing helps detect if an accountant has deliberately made mistakes or committed fraud. Difference between accountancy, accounting, and auditing. A fundamental principle differentiating accounting and auditing is expressed by the statement, where accounting ends, auditing starts. This means that auditing can only commence once the financial statements have been completed. Here's a breakdown of the differences. Scope. Accountancy accounting encompasses tasks related to understanding and applying accounting principles to record transactions. Auditing involves the examination of the work performed under accounting. An auditor verifies the accounts based on established accounting principles like GAAP, generally accepted accounting principles. While auditing has its own standards, it relies on accounting principles for verification. Commencement. Accountancy accounting begins where bookkeeping ends. Auditing begins where accountancy or accounting ends. Dependence. Accountancy accounting is independent and is not based on auditing as it precedes it. Auditing is completely dependent on accountancy as the auditor checks the information and financial statements provided by the accountant. They do not prepare the statements themselves. Qualification. Accountant. There are no legally predetermined qualifications required. An individual with software knowledge and basic accounting understanding can become an accountant. Auditor. It is compulsory for an auditor to be a chartered accountant, CA, as per law. They must possess a complete CA degree to perform auditing. Objectives of auditing. The objectives of auditing are categorized into two types: primary objectives and secondary objectives. This distinction is important for exams as questions often ask to identify which objectives fall into each category. Primary objectives, these are the main goals of auditing. Enhances credibility. When a chartered accountant, auditor, verifies financial statements and confirms their accuracy and absence of errors, it significantly increases the credibility and trustworthiness of those statements. This builds confidence among stakeholders like shareholders and investors. Prevents, detects fraud. Auditing aims to identify both unintentional errors and deliberate fraudulent activities by accountants. An auditor, with their deep knowledge of accounting, is well equipped to find such discrepancies. Improves internal control. The prospect of an external auditor conducting a year-end audit motivates internal auditors, company staff, to perform their tasks diligently throughout the year. This ensures that internal controls are effective, as any mistakes by the internal team would be caught during the external audit. Ensures compliance. A primary objective is to verify that the accountant has adhered to proper accounting principles and all relevant laws and regulations, such as the Companies Act, Sale of Goods Act, or Negotiable Instrument Act. Secondary objectives. These are additional functions performed by an auditor. Detection of clerical errors. Auditors are tasked with finding human errors, also known as clerical errors, which can occur during data entry or transaction recording. Examples include mistakes in totaling, incorrect amounts entered from invoices, omissions, or double recording. Performance review. The auditor reviews the company's financial position by examining expenses, income, assets, and liabilities. They provide insights to the company about its current standing and areas where performance, e.g., employee effectiveness and efficiency, might be lacking. Improvement recommendations. Auditors offer suggestions for improvements, particularly in internal control mechanisms. They might recommend specific software or personnel to minimize errors from the outset. A chartered accountant also provides broader advice to companies, such as optimal loan sources, interest rate benefits, and strategies for tax reduction. Types of audit. Audits can be classified based on various criteria, such as ownership and time. On the basis of ownership, this categorization depends on the type of organization being audited. Audit of proprietorship. In a sole proprietorship, which typically involves a smaller business, the owner usually decides to audit their own accounts. They often manage their own books and records, and due to the scale of the business, they generally do not hire an external auditor. Audit of partnership. In a partnership firm, partners may choose to audit their accounts themselves, especially if one of the partners is a qualified CA. Alternatively, they can hire an external auditor. Auditing is not compulsory for partnership firms. Audit of company. For companies, including joint stock companies, auditing of company accounts in India has been made compulsory under the Companies Act 2013. Companies are required to hire a qualified chartered accountant to audit their final statements. Audit of cooperative society. Cooperative societies also undergo auditing. The auditor for a cooperative society must possess expert knowledge of the specific Cooperative Societies Act, as their financial statements may have unique requirements. Government audit. This pertains to public companies, and government departments. The Government of India maintains a separate Accounts and Audit Department for this purpose. This department is headed by the Controller and Auditor General of India, who is responsible for auditing all government offices and departments. On the basis of time, this classification considers when the audit is conducted. Interim audit. Typically, auditing occurs at the end of the financial year. However, an interim audit is conducted between two annual audits. This might happen if shareholders or investors request a financial report and verification of statements mid-year, for instance, after 6 months. Continuous audit. This type of audit is performed throughout the year. It is generally associated with internal audits, which are part of a company's internal control system. Final audit. This audit takes place at the end of the year. Once all financial statements have been prepared, it is usually carried out by an external auditor appointed for this purpose. Based on objective, this classification focuses on the specific purpose or area of audit. Internal audit, conducted by a company's own staff or employees who have sufficient accounting knowledge, experience, or CA qualifications. Internal auditors often show greater concern for the company's well-being compared to an external auditor who primarily receives a fee. Cost audit, primarily conducted in manufacturing companies. This audit focuses on verifying cost accounts, e.g., prime cost, work cost, cost of goods sold, to ensure accuracy and to help control manufacturing costs. It deals with the cost accounting branch of accounting. Secretarial audit. This audit's objective is to ensure that the company's books of account are maintained and operations conducted in accordance with the Companies Act 2013. It checks for necessary approvals from the central government, company law board, or other authorities. Independent audit. This is performed by an external independent auditor. The main purpose is to determine whether the financial statements present a true and fair view of the financial position and profits. An independent auditor is considered unbiased, unlike a potentially biased internal auditor, and thus safeguards the interests of the owners more effectively due to their greater knowledge. Tax audit, related to income tax rules and compliance. It verifies the accuracy of tax-related documents, income declaration, deductions, and proper filing of tax returns. returns, including GST, goods and services tax filings. Tax audit has gained significant importance in the 21st century and now constitutes a separate chapter in auditing curricula due to the complexity of tax regulations and the need for companies to optimize tax payments and deductions. Information System Audit, IT audit. This audit evaluates an organization's IT, information technology systems. Its focus is on ensuring the confidentiality, security, and proper management of data, compliance with IT policies, standards, and cyber laws. This is crucial for protecting financial information and the investments of shareholders. Performance audit. This audit focuses on evaluating an organization's overall performance and results against its established goals, such as sales targets or profit objectives. It assesses the effectiveness and efficiency of employees and staff. Performance audits can be conducted by internal or external auditors or other specialized auditors and are applicable to various entities, including government programs, non-profit organizations, and private businesses. Qualities and qualifications of an auditor. The discussion of an auditor's qualities and qualifications primarily refers to an independent or external auditor, not an internal one. These attributes are generally categorized into three areas: professional qualification, statutory qualification, professional qualities, and personal qualities. Professional qualification, statutory qualification. This refers to mandatory qualifications. For sole trading concerns and partnerships, the law has not prescribed any compulsory qualifications for an auditor. Anyone can perform the audit in these types of firms. For companies, joint stock companies, it is compulsory for the auditor to be a chartered accountant, CA. A qualified CA must have passed the Chartered Accountant examination conducted by the Institute of Chartered Accountants of India, ICAI. Beyond passing the exam, the auditor must be entitled to practice, which involves completing a 3-year articleship, practical training under an experienced CA firm, and obtaining a certificate of practice. Practical experience is essential alongside theoretical knowledge. Professional qualities. These are qualities related to the auditor's professional expertise in accounting, thorough knowledge of the principles, theories, and practices of accounting, familiarity with different systems or branches of accounting such as cost accounting, management accounting, financial accounting, and tax accounting, thorough knowledge of various legislations and regulations related to business, including the Companies Act, Partnership Act, and Banking Regulation Act, awareness of various auditing techniques, processes, steps, and types of audit reports. Good knowledge of business organization, financial administration, and industrial management. CAs typically acquire this broad knowledge during their comprehensive course of study. Personal qualities. These are general human qualities that are beneficial for an auditor, though not legally mandated. Honesty, fundamental for success in any work. Tactful, ability to handle situations skillfully, elicit information, and find solutions to problems. Ability to work hard, dedication and diligence in performing duties. Impartial, remaining neutral and unbiased, avoiding favoritism or prejudice in their audit work. Cautious and vigilant, careful and alert, cross-checking information provided by the accountant and verifying facts independently. Methodological, organized in approach, knowing the proper sequence for examining financial statements and tracing facts and figures. Confident, possessing self-assurance in their professional judgment. Maintain secrecy, chalk confidentiality. It is crucial for an auditor to maintain the confidentiality of all financial and proprietary information obtained during an audit. Ability to communicate. Excellent communication skills are vital for interacting with various personnel in the company and effectively extracting necessary information. Common sense. The ability to make sound and practical judgments. These personal qualities, while not compulsory by law, greatly contribute to an auditor's effectiveness and professionalism.